I think I start with the product. What's the product? What's the product's reason for being? I want to understand sort of what is it that the company's selling. So usually there's a product description, product attributes, and sort of describing it. I think the product is to understand sort of what is this company selling? What's the reason for being? But I think the brand I think first of all the brand fits really closely into the product. So the product has to fit under a brand umbrella, and so I guess I would say I probably saw the brand on the cover page, and I think understanding sort of what is the brand's currency, how does the brand sort of extend itself, and all those questions are sort of secondary to sort of what do they already have in the market. So I think the brand is a close related part of that. Financial is probably the second, I guess the third thing. If I separate product and brand, I would say that financial is really important. So I want to understand what is the company doing, and how is it differentiated, or why is it unique? What is it bringing to the world? And then what has it actually been able to do financially already? What's the traction of that product? A product that, I guess first of all, having some product that makes sense, and not necessarily what I personally think makes sense or I think tastes good, but just I can understand sort of the positioning of the product and what market they're trying to serve. And then understanding what's the traction, and how does that traction compare to where they are in the life cycle as a business. So what I would want to see is, if they're very early stage, that's one thing, and really it's just about sort of how are they able to sort of show proof of concept that there's something here that people will buy it. As they get a little bit further along, and it's still not very large, I want to see traction with some sort of avenue to market, right? And so maybe they're only in one banner, so, one retailer, but they have shown good velocity, or they've shown an ability to expand their doors there, and understanding why that is, and essentially getting comfort that there's both a path to having broad distribution, assuming that's usually appropriate for most brands. So broad distribution, and also the ability to execute to get there, right? So have they shown as a team, as a company, that they can execute on a plan to expand their distribution? Those two things, the proof that there's something there, and the evidence that they can probably go execute on it, those are the two big things, I think. When I hand over money as an investor, or when the investors we work with, when I see them handing over capital to a company, it's with some aim in mind, and some aim of what that capital is going to be used for. And so that plan usually involves some sort of expansion in sales, and so understanding what that plan looks like, and having confidence in the company's ability to execute on it, and also having alignment as an investor with that plan. Like, you want to be closely aligned. I think longer term matters too, because then you're thinking about what's the ultimate exit, if you will, or how am I going to get paid back how am I going to get a return on my investment? And that's coming down to what is the eventual size of this business? Where can we see it growing? And that's important. So I think near term it's more specific, and longer term, but longer term is still really important.
Yeah.
So a company, when it's raising capital, can raise a couple different types of capital, right? First, it can raise equity capital, and that's a lot of what CircleUp does, is help companies raise equity from investors. But there's also debt or credit, and I think those two terms can be used interchangeably. Within credit, there's different flavors, okay? And so one might be, you can go get, as a founder, you might be able to go get a cash loan that's not really guaranteed by any sort of assets in your business. It's just essentially guaranteed by you as an individual. And let me just say, if you're a larger business, if you have, I'm making up numbers, but let's say $10 million in revenue, certainly if you're profitable, then that unlocks some additional opportunities, what you might call a cash flow loan, where a bank or some sort of credit provider is taking comfort in the fact that you generate profit. So they will loan you money and you will pay you interest. But when you're smaller and you're earlier stage, essentially you're borrowing money as an individual, what's called a personal guarantee, that you will pay back that money. Or you can do asset lending. And asset-based lending is where you borrow capital secured by assets in your business. What are assets that companies have? They have inventory. They have accounts receivable. So they promise that a retailer is going to pay you back. And so even if you're a very new brand, if Whole Foods, Costco, name your favorite retailer, owes you money, so you have an accounts receivable from them, that essentially is credit backed by them. And so lenders are willing to, in some cases, lend against that. So you might be able to get cash in your pocket today, even though you haven't collected from your retailer. That would be an asset-based loan. And the advantage of credit in general is that it's non-dilutive. So you as a owner of a business, you don't have to give away any of the shares in your business to get credit. So that's the advantage. Asset-based lending specifically has an advantage that it's typically a lot cheaper. So the APR, the interest rate that you pay for asset-based lending is going to be lower than just a typical sort of cash loan advance payment that you get from anyone who might give you that, just as a base of, it'd be equivalent to me saying I want to go borrow $10,000. Someone might give me $10,000. I'm going to pay more for that than if I had AR inventory to borrow against.